Welcome to today's municipalbonds.com webinar on muni investing, what to expect during the fourth quarter. I'm Matt Butcher, VP Sales here at municipalbonds.com. Today's webinar is brought to you by the DRL Group, and today's presentation will be about a half hour long and be followed by a brief Q&A. Please submit your questions for the Q&A using the webinar cockpit anytime during the presentation. Any questions we don't get to will be followed up after the webinar is over. Now, I'd like to introduce your host and presenter, DRL Group's principal and owner, David Lesh.
Hi, thanks, Matt. First of all, I want to say thanks for joining us. Everybody is hopefully safe, well, and everybody is happy, and thank you again for joining us on this webinar. That's who we are. We're DRL Group. We're fixed income specialists, and we trade fixed income bonds for a living. I've been doing that for about 30 years now, all different types of markets. And I know some burning questions out there, so we're going to get right to it. That page right there is for the legal or for our compliance. Again, this is recorded, so you can go back. Just to get into DRL Group right now, just to kind of give you an idea who we are municipal bond and corporate bond traders. We trade high-grade municipal bonds and high-yielding corporate bonds. We have 6 traders that trade with us that manage various different parts of the country. From a corporate bond standpoint, we have traders that manage different areas within each sector. We buy primarily on the bid side, and really what that means is that we are really not on the offer side. We really don't go lift offers. We're more on a bid side basis. We have underwriting relationships, so we also participate in many underwritings that come out as well. Most of those underwritings go into institutional accounts, and most of those underwritings are done on a all or none basis, which means that most of the institutions that buy them take them all or none. We are market timers as far as trying to do the best job we can with real-time market time data, and we provide the pricing to the retail customer and to the institutions with a better yielding opportunity because of the fact that we're on the bid side of the market. I've been doing this since 1994, August of 94. I've been with DRL Group. We started this about 25 years ago. I've always done municipal bonds and corporate bonds, and we've always been on the dealer side of the market. We're not retail brokers. In other words, we don't deal with a different trading desk. We are the trading desk. So when you do business with us, you're doing business with our active trading desk. You would either do business with myself or somebody in the firm itself. We have about 600 high net worth individual accounts. Right now, I looked this morning, we have 647. We have 14 institutional accounts as well. Those institutional accounts would be like Breckenridge Advisors, Vanguard, Putnam, Nuveen. We do not charge an annual fee as well. We make our money on a small minimum markup as we sell the bonds to the retail customer or to the institution. There's something out there called a wrap fee or an RIA. I'm sure some of you guys have heard about that. We do not do that. Our secondary focus is high yield corporates. We trade a lot of high yield corporates from the standpoint of if they make money, are they liquid, and are we looking from a trading perspective, or are we looking for a buy and hold perspective? We always, from most of our clients, we get the same reaction. Hey, I'm seeing a lot more product flow from you. I'm seeing a lot more bonds from you. Can I see more corporates? And so we've started to move into the corporate market. We've always been in the corporate market, but as we're going to talk about here in another minute or so, yields have been significantly depressed. So a lot of people are moving into the corporate. We manage fixed income 100% of the time. We do not do anything else other than manage fixed income. The last slide on DRL is research. So we have decades of experience within our office. Last I counted, we have about 85 years of experience managing high net worth money on high grade securities. So we do a deep dive in each issuer, and we make it a point to understand the issuer itself. When we're looking at a bond insurer, we make it a point of understanding the claims paying ability on the bond insurer itself. There are bond insurers out there like AMBAC and BIA and FIGIC that we don't really trade. AGM, Some National, BAM, Berkshire, those are the ones that we trade. We understand them. We sit on conference calls with them. We understand what they're doing, how they're doing it, and if they have what's called the claims paying ability, like I said. bottom line is we understand the complexities of the fixed income market. We really do understand what the client needs and how we operate with the client itself. So enough on DRL Group. I know everybody is talking about, oh my gosh, we've seen a big rate move in the 10-year and the 30-year. We've seen this big economic move. We have this debt ceiling coming up that might or might not be fixed. Obviously, I'm of the opinion, of course, it'll be fixed. A lot of people are getting very concerned about what's going on in the Biden administration and how that's going to impact munis. And that's really what this is about. It's not about DRL. It's about how this overall process that we're going through with the debt ceiling, with the credit ratings being increased or decreased, and with the $550 billion package that's out there. Why are we buying munis now? Well, you would think that, okay, well, rates are going up, munis are going to get a lot cheaper, and rates are going to go significantly higher. Municipal bonds typically trade and lag behind treasuries. Normally, as an example, as I put on there, treasuries gained roughly about 30 bips over the last 3 or 4 days. Muni bonds gained about 13 bips. So as we're trying to look at different types of munis and look at what's to buy and whatnot, we're trying to understand the fact that, hey, listen, muni bonds are really trying to what is going on and how we're going to do that. Let me get that out of there real quick, because you guys can see that. There we go. High grade paper continues to trade very, very well in this market, even though we're down in price and up in yield. We're primarily focusing on the shorter and midterm type into the curve. We're not really going out 35, 40 years. We're trying to stay within a 10 to 15 year time frame. Most everything we're purchasing is going to be a 5 to 7 year call. As of late, we're trying to get between a 2 and 5 year call. That's pretty difficult to do. However, with that said, it's from a bid side perspective, we're able to get that done. There is trillions of dollars, both based on the Trump administration and the Biden administration, that has gone into the muni market. There's a $550 billion deal right now on the table. Pelosi is negotiating with that. That's going to go into municipalities. And I've got a slide on that. I've got a slide on what it's exactly going into. At the end of the day, that's going to create higher taxes. Municipal bonds are one of the last true tax havens that we can buy. That's a liquid security, not private equity, a liquid security that you can go in, buy and sell and understand and manage that debt. Inflationary risk is a problem. I will not debate that. I know a lot of people on the call are saying, okay, we're seeing inflation. Powell is saying, hey, check back with me in a year. I'm not 100% sure if this is an inflation deal or if this is huge pent-up demand and people are out there looking at this pent-up demand. At the end of the day, we all know that yields are higher. If you're a bond buyer, you know that yields are higher. Yields are higher today than they were yesterday than the day. Today, bond prices are probably going to be marked up 2 to 3 ticks, which means they're going to be moved from a 150 to a 152 or a 153, that kind of thing. So we're going to continue to see this markup in yield until we see some sort of debt ceiling issue. The Fed believes, and Powell just said this last week, the Fed believes that at the end of this year, we're going to see some sort of a inflationary hub. So, that's what's going to be happening from that standpoint. Let's go right into what's going to happen with the outlook with the departing Fed members. As we all know, we've got 2 Fed members that are departing. That is really going to make the 2022 rate move very suspect. So if you read that, the blue is vote, white is not to move. So at the end of the day, most people on the Fed at this moment believe that there should be no move in 2022. That was published actually this morning. So getting right into the rate move, the Fed feels that, hey, look, you know what? We're not 100% sure if we're going to move the rates in 2022. Now, I will confess and think that we're going to see tapering. And I think we're going to see tapering at probably next month, November. Typically, it's almost October, November or December. We're probably going to see MBSs, which is mortgage-backed securities, tapering. And then from there, we're probably going to see a little bit of Treasury tapering. I would think 75-25 in that respect. The Fed's new dot plot from last week. So everybody on the call probably knows what a dot plot is. That is the anticipation of rates moving up. Most folks think that rates are going to start moving up sometime in 2023, not 2022. I personally think we're going to see a move at the end of 2022 or the very, very early 2023. I do not think we're going to see a move between now and the last quarter of 2022 for sure. So with that said, that's the new dot plot. Going into the taper, are we prepared? If any of you traded bonds or bought bonds on the last taper, you knew that yields spiked. Yields spiked huge. The reason they have spiked huge, there's a very simple reason. No one was prepared for any type of tapering. At the end of the day, when we look at tapering, we go, okay, fine. Are we prepared? Is the street prepared? Is the client prepared? Are you going to hit the bid if you start to see tapering? 67% of the economists out there and the street believe that we're going to see tapering in the next 2 months. That is a huge difference. Back in the last tapering, which was around 2013, that number was about 32 to 30%. So it caught everyone off guard, and it really made people nervous. And that's the reason why you saw yields spike. Why do we think yields are probably not going to spike? Again, everybody is very prepared for the taper. We believe that that's going to happen. We know that we're seeing inflation now. And for the most part, what we're seeing is temporary inflation. The Fed chairman, Janet Yellen, and all the Fed committee have said, we need to look at where we are in 6 months to a year from now, instead of looking right now. Everybody's getting out. We're all done with COVID, so to speak. Obviously, we're not done with COVID, but everybody are getting out, having fun, doing things, getting on planes, going to parties, buying cars, pent up demand. So once that pent up demand goes away, we need to really discuss, okay, fine, how are we going to address the taper? What are we buying in munis, and why are we buying them? What are we buying is easy. Well, that's easy. Greater than a 5-year call, less than 20-year maturity, primarily insured dated paper. New issue paper is coming out between a 225 and a 250 yield to call on AA rated paper. We're buying all that stuff. Why are we buying that? Well, we're focusing on higher education, essential service, and COVID type infrastructure. Why? Is because of the fact that higher education institutions have huge endowments. There's no issues with those guys. University of Texas, where my kids went, big endowments. They're able to pay off bonds, or they're able to refinance bonds. Easy, no issue, no default rate risk. Very little, if that. Essential services, there's a slide coming up. It's obvious to us, and it's obvious to the street, that the Biden administration is going to push the $550 billion out. There's no question about that. And that $550 billion is going to go to overall essential services deal. Anybody living in New York City, MTAs, Metropolitan Transit Authority, they're going to receive a boatload of money because of the fact that they need the cash to enable to operate. They're going to receive money. Airports are going to receive money. Toll roads, infrastructure, water and sewer, et cetera, et cetera. Airports have been a big buyer. We've been a big buyer of airports. They've done extremely well, and we're continuing to buy investment grade insured type airports. Granted, the yields are lower than non-investment paper. If you're looking for non-investment grade paper, high yield paper, we're probably not going to be a good source for you. But if you're looking for high grade paper, low default risk, that's what we're focusing on. And that's really what we're doing. Going long munis in this market, why are we doing that? Well, right now, typically, historically, the right level has been between a 135 and a 175 on the 10-year T-bill, which is the Treasury. Look back the last 5 years, look at the Treasury, look at what munis did. Just go back and look at it. We have graphs. We're happy to talk to you about it and show you why the volatility happens between a 135 and a 175. It's almost like when the Treasury gets to a 150, there's a buy signal, and all of a sudden it bops back down to a 145. Currently, it's about a 153 right now, 152. It's holding steady for the day. If it gets to a 175, that's great. That's a huge buying opportunity. Below 135, we're probably not going to be a big buyer on that. So between a 135 and a 175 is the number. There's data to prove that. Just go back and look at it. Look at MUB and then compare it to the Treasury. Tapering has been noted. We already covered that. The street is prepared for tapering. At the end of the day, we're prepared for that. I can't stress that enough, because if we look back on the last tapering, it go, oh my gosh, the yields just went way up. Okay, well, that was because no one was prepared. There's a massive shortage in bonds. And I know some of our clients are on this call right now, and they're probably, hopefully, shaking their head going, yeah, okay, I can't really find any paper that meets my parameters. Well, at the end of the day, the reality is that dealer inventories are super low. There has been very little issuance. What issuance has happened has gone into either institutional accounts or dealer accounts like ours or other dealer accounts. And so there's not a lot of paper to go around. Not to mention the fact that municipalities, for example, Chicago, are saying, hey, look, we don't need to issue bonds right now because we're going to get this boatload of money from the Biden administration. I mean, why would they go long bonds or why would they go long debt if they're going to get this money? I mean, that's what's going to happen. And that's the reason why you're going to continue to see issuance go down. Personal income taxes, we're not going to spend a lot of time on that. I'm not a tax attorney. Go talk to your tax attorney. Ask the tax attorney, hey, look, you know what? What do you think that taxes are going to do next year? I would willing to wager 90% of them are going to say, you know, your taxes are going to go up. Well, why are they going to go up? Well, we just covered it. Who's going to pay for all this stimulus? I mean, somebody's going to pay for it. It's probably going to be you and me that's going to pay for this stimulus. And finally, rates have moved up. We've already covered that. They've moved up. Muni bonds have moved up basically 15 to 20 basis points roughly on the long end, 5 to 7 basis points on the shorter end, and probably 7 to 12 basis points on the middle end. So, you know, it's really a buyer's market. Just keep in mind that 135 to 175. I've talked about the U.S. stimulus package, $1.9 trillion. That's the American Rescue Plan in 21. That's going to benefit the municipal bond market. There's no way around it. At the end of the day, they're going to move the money into the municipal bond market. They're not going to let the municipalities fail. I can't guarantee you we're going to buy the bonds at the cheapest rate possible or the best rate possible. I'm not here to debate that. That's not about this webinar. It's about how are municipal bonds going to react when this money hits the street? Well, they've got strong technicals that are going to be extremely welcomed by the municipalities. I mean, Chicago, I mentioned that just a minute ago. A couple of weeks ago, they were going to do a deal. They canceled the deal. It was a $550 million bond issue. They canceled it. The reason they canceled is they don't need the money. They're saying, well, we're going to get this money. It's not a big deal. S&P and Moody's, I have a slide coming up. Credit ratings have moved up substantially. You know, we coming out of COVID and you would think, okay, everything would be going down. But in all actuality, sales taxes are up. Municipalities have plenty of cash. They're paying all their bills. Very little, if any, defaults on high grade securities. And you know, there's not a lot of bonds out there. So anyway, that's where the infrastructure is going. So that gives you an idea. So when you see muni bonds that deals with roads and bridges or electric grid upgrades or rail like Amtrak or MTAs or broadband expansion, which that's kind of new, clean drinking and transit, I mean, that's where the money is going. That is a major boost to these municipalities. And that's going to be a major boost to your portfolio from an upgrade standpoint, from a credit quality standpoint, and people are going to start looking for those high grade securities. I'm not going to debate the fact yields are up. We all know that. We're all on this call. We're all bond buyers. We get it. But what's going to really happen in 2022? How is this really going to impact? Yields are up because of the fact, like I said, we've got the debt ceiling. What are we not buying? That might be equally as important. This is just what we're not buying. You might be buying this. That's great. We're not buying small higher education facilities. Some regional college, for example, I live in Texas, Childress, Texas, which is in the Panhandle as a great example. We're not really buying small regional facilities. We're certainly not buying regional hospitals at all. One would think COVID would have done great for hospitals, but at the end of the day, hospitals have had a really difficult time. And you can't get into a hospital unless you got COVID. We have clients that have knee replacements, for example. They can't even get into the hospital, or it's a 2.5 or 3 week wait for a bed to get the knee replacement. It's really difficult out there. Alabama, PA, and Tennessee, we're somewhat avoiding the higher education facilities in those states. The reason why is because for some reason they've had an abnormal lack of enrollment. There was an article in Wall Street Journal and there was an article in Bloomberg not terribly long ago that spoke about that. I found that to be very, very interesting. We track these things and we make sure that we're not buying stuff, or at least when we're looking at it, we go into the enrollment situation and say, okay, look, what kind of things are going on in this particular state that deals with this particular, in this case, college. So we're really, really careful about that. And we're not buying any land deals. Land deals where the primary source of payment is a developer, we shy away from those. A lot of the street shies away from that as well. Usually those deals are small, and we don't really trade anything less than $100 million because of the fact of the liquidity. But nevertheless, if there is a land deal that's out there, it has to have a solid backer developer, it has to have some sort of mineral rights to it that's a producing well or a producing asset, or we're not going to touch it. So that's what we're not buying. Again, that's just our preference. I'm not suggesting you not buy it, but that's just our preference. Do what you want to do. Nursing homes lead the sector in defaults. So that bottom left graph right there, that blue, that's what's called in our business CCRCs. That stands for Continuing Care Retirement Centers. So if you're talking to a broker, if you're talking to us and you say, hey, I don't want any CCRCs or anything, if that person doesn't know what you're talking about, then you need to ask that, because of the fact that CCRCs are a leading default. By the way, they've been a leading default, but they've been a leading default as far as what's going on. Most of these are, of course, non-rated or very poorly rated. Obviously, they're not insured. So, one thing that our shop really doesn't do, we don't trade a lot of lower rated securities, and we don't really trade a lot of non-insured stuff as well. We try to stick with A-rated or better, and it has to be a solid A-rated or better. High yield corporates, as I said, there's reasons to buy that. If you're looking for higher yield in your portfolio, we trade that. But things that you need to know about corporates, obviously, is that they're not insured. If you're comfortable with that, that's fine. Obviously, if the company is making money, then we can mitigate that. It's an additional asset class to what we're putting on right now with our book. And I would advise you, if you are a muni buyer, talk to your broker or talk to us, talk to somebody about, hey, should I be looking at some high grade corporates? What are the yields? What is the duration? And what are the risks? Well, the risk obviously is they could default. That's pretty self-explanatory. You're betting on the corporation. Now, if you're betting on McDonald's, likelihood is probably pretty low. You're betting on some small company, obviously the likelihood is high. So it does offer a greater return for a shorter duration, but you have to be aware of what you're buying. You have to understand what you're buying. 5 to 9% is about what you should expect. Obviously, the higher the yield, the more risk there is, of course. Most corporates are shorter duration. Most corporates are, say, 10 years. Now, there are some, obviously, that go out way far into the ozone, but most of the stuff we're trading, at least, and most of the stuff that we're trying to advise the client to trade is less than 10 years. We try to stick around 3 to 7 years on a corporate. It's tied to a publicly traded company, and that's really all we trade. You can trade a corporate. It's easily researchable. You can obviously go to CNBC, hit the ticker, and look at what the financials are. It's pretty simple as far as that's concerned. It is a great diversification of munis. It will track the equity market a little bit closer than munis. So if you're not prepared for the volatility, I would not advise you to trade corporates. But if you're prepared for the volatility and you're okay with that asset class, that's a pretty good deal. Those are the ones we're buying down below. So all good companies, you can talk to us, you can look down on yourself, but those are the ones we're buying below. They're good for tax deferred account as well. And by the way, while we're on corporates, the taxable muni market will, if Biden's deal gets passed, which I think it will, but if it does, the taxable municipal market for 2022 should receive a large influx of issuance. And the reason for that is, if you guys remember, there's something called Build America bonds, or BABs, B-A-B-S. When the Obama administration issued Build America bonds, part of those bonds were guaranteed payment, approximately 35%, by the government. So say a municipality where I live in Houston, for example, part of the municipality of Houston would issue a taxable bond, and part of that money, part of that debt service was paid by the local government. That went away when the Trump administration came back. Biden administration is trying to bring it back. It's not done yet. I'm not suggesting it's done. It is on the docket. They are trying to make it happen. If it happens, you should see a lot more taxable paper in 2022. By the way, I think it'll happen, but we'll see. Going back to corporates, corporate default rate risk. Obviously, we've already touched on that. They're greater than high yield bonds. They're greater than high grade bonds. They're not insured. Make sure that you have a solid credit rating. Those are the default rates for credit ratings within the corporate market. Investment grade corporates, very low default rate, but the reality is you're not going to get paid a lot on investment grade corporates. Just know that. Triple B rated and above, they're going to outshine munis, particularly the triple B rated, corporates are going to outshine munis, meaning higher yield. But when you start getting into the AA rated corporates, certainly the AAA rated corporates or the A rated corporates, there's not a lot of delta spread between munis and corporates, just so you know. We have controls in place to manage this stuff, and most broker dealers do, both from the offer side, from the bid side, and tracking overall credit ratings. So go back to the Fed. You know, it's funny. When you have a roaring US economy going, you see a recovery and you see inflation. We can all say that there's inflation. This call is not about no inflation. Since 2008, you would think that yields would be like sky high meaning 4%, 5%, 6%, whatever, on munis, on high grade munis. That's really not the case. If any of you are buying munis, you know, particularly A-rated or better, you know that it's hard to get yield out there. And you would think, gosh, David, wow. I mean, we're seeing this massive inflation. We're seeing the 10-year hit at 150, 30-year hit at 205 or whatever it's at. I mean, what's going on? Why am I not getting 4% on my munis? Well, I mean, your guess is as good as mine. I mean, at the end of the day, the market's telling you that munis are still a valuable asset to own. So, you know, that's where we're at. The Q&E from a November standpoint, as I said, we're probably going to see that tapering, and we anticipate rates starting at the end of 22 and 23. With the recent rate moves, like I told you at the first slide, munis have ticked up basically 15 to 20 bips. Today, they'll tick up maybe 2 or 3 bips. I think that's going to start to taper off. And as long as we get this debt ceiling issue under control, I think that will be solved. Banks, you guys have to know that with higher rates, corporate rates that is, banks are moving back into the municipal bond market. They were heavy in the municipal bond market 2 or 3 or 4 years ago before Trump. They got out of the municipal bond market because their corporate income taxes went down. Now they're starting to get back in. We're starting to see institutional, bigger banks come back into the muni market. They're buying A-rated and AA rated stuff, primarily focusing on AA rated stuff. They are looking at new issues, which is a good thing for overall munis themselves. That is the states that are going to get the money. So the darker the blue, the more money they're going to get. What's interesting is that a lot of the states haven't even used their money. For example, Georgia, Missouri, and Texas, where I live. I mean, we received money, I don't know, say 6 months ago, 8 months ago after COVID, and Texas really hadn't deployed any of it. And the reason is they're just sitting on it going, okay, we're not sure exactly how to deploy it or what qualifications should be deployed, but they will start to deploy it. Under the Biden administration new plan that Pelosi's pushing out, they're going to have to deploy it. So this will all be good for municipalities and good for credit qualities. State and local jobs, we still have a long ways to go. I mean, at the end of the day, high grade securities will still be a safe bet. There's a long ways to go from a job perspective. That graph takes you up to basically August of 2021. There's a long ways to go from a recovery standpoint. It is a lethargic rebound. And maybe going back to the other slide, that's the reason why munis aren't yielding a 4% or aren't yielding a 3%, is because the dealer community out there and the investors out there know, hey, look, I'm not convinced that this recovery is for real yet. Come back and check back with me in a year from now after everybody up this pent up demand stuff has kind of settled down a little bit. We can't base our decisions today when everybody's been sitting on the couch for the last 6 months because they're too scared to go out because of COVID. So that's Powell's thought process, at least. $60 billion of capital have come in. That orange line, that's a little, goes up to August, but at the end of the day, that orange line continues to go up. $60 billion has seen coming into their fund flow 66 weeks. There has been positive inflows of $149 billion. What that means is that there is a ton of money coming into the muni market. You would not think that. You would not think that, okay, well, I'm not interested in a 2% bond. Okay, that's your prerogative. I get it. That's fine. But that's really not what's happening out there. So it's been an amazing ride. Go back to credit quality. Positive rates. So since COVID, $55 billion of changes, lowered outlook, 55 billion has been raised, and 977, that's billion, by the way, has been raised. So raised, upgraded, and lowered. Most everything has been either raised or upgraded. The reason being is because of the fact that the GO bond stuff, the airport stuff, the toll road stuff, the water and sewer, that kind of stuff, S&P is looking at that going, we believe tax revenues are going to continue to be strong. We believe this whole work from home thing is not going away. We believe people are going to start to build and buy houses, which of course we're seeing that already in housing prices. So all of that stuff is doing well. Largest sector downgraded, no surprise, hospital debt. If you own hospital debt, if it's uninsured, I'd be very careful. At least look at it. Ask your person, hey, look, give me the financials on this hospital so I can make sure that this thing has the ability to pay. While you're at it, I would also look at CCRCs as well. So just FYI. You know, everybody talks about 10-year treasuries. We've mentioned that on this call probably 15,000 times now. But look at that just for 1 second. Look at the US, 148. Right now it's a 153, 150. This is dated 9/27. But look at everybody else. I mean, you know, obviously Mexico, of course, or Brazil. I'm not talking about them. But look at Canada, look at the UK, look at France, look at Germany, look at Italy. I mean, that's a little surprising, because if you have large sovereign nations out there or large institutions that are moving money around, and maybe that's why you see a buy signal at a 150, is because of the fact that we are indeed the cheapest house on the block at this very moment. So with all of that said, you're looking at this going, wow, okay, man, a 148, gosh, we could go to a 2%. Well, look at everybody else out there with the exception of Brazil and Mexico. If you want to go invest in Brazil and Mexico, right ahead. But I mean, what is the UK going to do? Are they going to offer you 0.95? I mean, that's keep that in mind when you're making decisions. Just keep that in mind. And then lastly, just to kind of go over our overall desk and how we operate, that's a traditional trade right there. The street trade desk, they take a markup, broker takes a markup, and then you receive a higher price and a lower yield. That's the traditional way things are being done. This is ours. We deal directly with street. You're dealing directly with the desk, myself or my team, and then you receive a better pricing and a better yield. We're happy to talk to you about spreads. We're happy to talk to you about where we bought bonds. We're happy to talk to you about, hey, look, we can't work for less than $100. You know, we're happy to talk to anything about that. We're transparent. We're open book. But at the end of the day, we're going to show you most likely a higher yield and more product. In summary, this is the last slide, and then we'll go to the questions. In summary, fundamentally, munis look strong. $550 billion is most likely going to be pushed out. I cannot imagine that deal not getting done. It's going to go to state and local municipalities. Low supply for the foreseeable futures. Why would municipalities issue bonds if they don't need to? Okay, well, if we have a rate move, of course, we're going to see higher yields. Great, fantastic. I'm sure everybody on this call has cash tucked away in their money market account for the rainy day when back the truck up. We call it back the truck up. 9/11 back the truck up when everybody was scared. Meredith Whitney back the truck up when she predicted all the defaults on 60 Minutes on a Sunday night. Obviously, COVID, we should have backed the truck up. We bought bonds. Everybody was scared. They were going, oh my gosh, what's going on? Taper tantrum, crisis in 08 and 09, mortgage crisis. Look back on any of those things. We'll keep money powder dry. We're not saying do it all, but you know, we're not going to have a major hike or a major spike in inflation or rates, in our opinion, and in most of the street's opinion, because there's a lot of things that are counterbalancing that rate hike and then taxes, and then rate hike and then less supply, and rate hike and then you have credit quality. So you have a lot of things there that are counterbalancing one another to where, okay, yeah, rate hike, okay, maybe we'll go back, but then you're going to have a bunch of money come in 2022 because the guy's going to go to their account and go, oh my gosh, you mean my taxes are up? Oh gosh, buy me muni. So you're going to have that come down. Almost zero default rate. I mean, you know, so if you're looking for a comforting security, that's a very comforting thought. And then lastly, credits will benefit in 2022. We've already held that. So Todd, do you want to go to the questions, please? That's the last slide.
Hi, David. Yeah, we've got a question about tapering. Just a reminder of what exactly tapering is, maybe for the folks that aren't aware.
So tapering is, think about it like this. So the Fed comes out each month and they buy securities. So let's just keep it simple. let's say that there's a float of securities of $30 billion a month. Just use that as an example. The Fed will come in and buy $1 billion of those securities per month. And the reason they do that is because of the fact that they buy those securities and take them out of the market. If they taper, what that means is that instead of buying $1 billion worth of securities, we're only going to buy $500 million worth of securities. So they taper or reduce their overall purchase of those securities. So tapering, in theory, tapering will say, okay, think of it as anything else, supply and demand, back when you were in college. If you have greater supply and less demand, prices in theory should go up. Pretty simple. So if there's tapering, meaning that I'm not going to buy that billion, I'm only going to buy 500 million, there's greater supply out there, of slightly less demand. And so in theory, rates should go up. The reality with that is that if everybody is already aware of the tapering, as I mentioned before, then the street is prepared for that tapering. And in addition to that, it's not really going to affect our markets that much because they're going to start tapering. They buy two things, by the way, treasuries and mortgage-backed securities, two things. So those are the two instruments that they buy. They might buy a little bit of other stuff, but the bulk of it is mortgage-backs and treasuries. They're going to taper mostly on mortgage-backs. The reason being, I don't know where everybody lives. I live in Houston. Our kids live in Austin. Austin's home prices, Houston's home prices, they have skyrocketed. So the Treasury's looking at this going, I need to start tapering on MBSs, mortgage-backed securities, in order to kind of reduce that skyrocketing. And in a way, that's going to happen. So they're going to focus on MBSs. It's not really going to impact the muni market. But tapering, bottom line is, I'm buying 500 million, not a billion. Go ahead, Todd.
Next question we have, do you know about 30-year natural gas prepays? Is that something you want to touch on?
No, we don't. I think what that question deals with is some muni bonds for natural gas prepays. That's not something we really trade. I can find out about it if I have a QSIP, and they can just email me a QSIP and I can find out about it. But I'm not qualified to really talk about that on this call at the moment.
Okay. Next question, is your assumption that the debt ceiling will be fixed by Friday?
No, we're talking about Congress. No, I think they have like a 10-day or 15-day, something like a 10 or 15-day kind of, let's just say a grace period, I guess would be a best word to use. No, it's not going to be. They're going to kick that can as far as they can. It will be fixed. I will say that. And that's why you're seeing this yield trade down or trade up and prices trade down, but it will be fixed. It's just a matter of time. It'll be fixed by the 15th of October, but by Friday, probably not, I would think. I'd be shocked if it did. If it did, then expect yields to go down.
Got it. Next question, what states bonds and what corporate bonds are you staying away from? I think you touched on this slightly in the
states, it's interesting because states, one would have thought that California, New Jersey, and New York, those guys would be, high tax states, obviously, those guys would be really, really hurting. But California's actually done very well. They've been upgraded once since COVID. Their sales tax collections are running at about 18% higher than what they anticipated. New Jersey's sales tax collections are running about 12.5% higher. New York's are running a little bit higher. I don't have a good data figure on that, but we're not really avoiding any quote state. We're not really buying a lot of Washington State and Oregon State bonds. The only reason for that is that it is kind of strange to see, and I don't want to offend anybody on the call if they're from Washington or Oregon, but it is kind of strange to see how their government is working. We're kind of steering clear of that. New York, we're pretty selective, but at the end of the day, New York's going to be just fine. As far as corporate paper is concerned, that's an easy question to answer. We're not buying anything that's losing money. We're not buying anything that is less than, say, $50 million in issuance. Preferably 100 million, like I mentioned earlier. And we're not buying anything that is in any type of hospital type sector. We're staying away from that. So, solid companies that have solid cash flow, good free cash flow, obviously net income, and cash in the bank. That's another big thing, cash in the bank. They have several maturities in front of your maturity. If your maturity is in 27 and they have a 25, 24, and 23 maturity, they better have cash in the bank or adequate financing in place with the bank in order to finance those maturities. So we're being very careful about that. And that really is applicable to really any company we're buying, but more so if the company is a smaller company. Go ahead.
Got it. Next question. Someone was asking how many dollars to invest with you with DRL Group. Is there a minimum?
We really don't open an account for less than $250,000, and we like to establish a relationship with that account to understand what that account is. If the account is a brand new bond buyer and really needs a lot of education, then that's okay. We can do that. But we really try to stay at 250 or above. Our average account size, just so you know, is roughly about 10.5 million, roughly thereabouts. So, but we're happy to take accounts, and we're happy to educate accounts if they're getting into the market. If they're an experienced bond buyer and they know exactly what they want and they have accounts elsewhere, obviously we'll work with that bond buyer. If they're getting into the market, then we need to have a discussion about what their overall objective is. What we're not looking for is somebody to buy $100,000 worth of bonds and we never hear from them again. That's not what we're looking for. We're looking to establish a relationship with the account and understand how the account works and what the account needs. Go ahead.
Great. Can you share some more thoughts on looming tax rate increases? Was a question.
Yeah, that's a big discussion. I mean, that's a whole nother seminar. I mean, the reality to tax issue. I mean, we really have four issues that are plaguing the U.S. economy right now. You have corporate income taxes, which that's pretty well known. It's going to go to 26.5%, I believe. They originally thought 28, but I think they settled on 26.5. That's up from 21, by the way. You have obviously personal income taxes out there. There's a lot of debate on what's going to happen to the 37.5%. Is that going to go to 42? Is it going to go to 39? Is it going to, where is it going to go? Most economists out there think it's probably going to go to 39 or 40. When you throw on top of other taxes, you're probably at a 42 or 43% bracket for self-employment tax and so on and so forth. That tax will probably go up 2 or 3% across the board. Biden indicated anybody making less than 400 grand is not going to get a tax increase. That's pretty well out the window. Most panelists that I sit on some panels with economists once a quarter, and most economists out there and most dealers out there also think that that's not going to happen. It'll probably be a threshold of about 200,000. You got AMT tax. That will go up. So if you're buying AMT bonds and if you're subject to AMT or if you're not subject to AMT, have a discussion with your accountant because they're going to target AMT tax for sure. And then lastly, the overall capital gains tax. There's a big debate out there. Biden wants it to be at 39, I think, or 38%. Congress came in at, I think, 36. They're probably going to meet somewhere in between. So, if you own a lot of equities and you've got big gains, by the way, no one really thinks this is going to be retroactive. They don't think it's going to be through June of 2021, for example. I mean, most everybody thinks it'll be 1/1/22 if it happens, which it most likely will. So cap gains taxes, I would pay particular attention to that. That's going to impact, obviously, equity markets. And if you got a big gain in Google, for example, you might want to be careful about that because cap gains taxes will definitely go up. For those that you don't know, there's something called a trailing percentage stop. If you're not familiar with that terminology, ask your broker or call us. A trailing percentage stop. And so if you have an equity that's gone up significantly, and obviously everybody knows what a stop loss is, but that's a specific dollar price, but you might want to put a trailing percentage stop on there. So if you have a big move in the market, that trailing percentage stop moves too. But that's a conversation for another day. But at the end of the day, taxes are going to go up. AMT, personal, corporate, cap gains. Everything else, the GST that he was talking about, they're still looking at 1031 exchanges. So if you own a bunch of real estate, kind of look out for that. And, cost basis, they were thinking about doing the stepped up cost basis and doing away with that. That would be horrific if that happened. And I'm sure everybody on this call would agree. That's probably not going to happen. That's a major tax move. So we publish Tuesdays and Thursdays on our website various things about the market itself. And from time to time, we put tax stuff. So I would encourage you to sign up for that if you want to watch the tax codes change, because that will be coming out here shortly. Go ahead.
I think we're at time, David. There's a few more questions, but maybe those can be followed up on after.
Yeah, that'd be great. We can follow up with those. I really appreciate everybody joining us. I try to make it fun, casual, and just informative. If anybody has any questions, give us a call. And we're looking forward to talking to you. I appreciate the time. Hope everybody stays safe and healthy. Thank you very much. Have a nice afternoon.
Thanks, David.